Welcome to the Legal Issues That Shape Investment Deals webinar. As Johnny explained, it's the seventh one in the series that we've been running. So let me just first, for some of you who may not know or are new to this webinar series, let me just explain a little bit about Manufacturing Africa. It is an FCDO-sponsored program that has been running for the last, so it's a 7-year program, been running for 6 years in 6 countries, which include Kenya, Tanzania, Rwanda, Ethiopia on the eastern side, and Senegal and Nigeria on the west coast. The program's key goals are to attract foreign direct investment. The target was 1.9 billion sterling pounds, and to date we've managed to get 2 billion pounds worth of investments across these 6 countries. And job creation is another underlying target. 99,000 jobs to date. We've got about 100,000 jobs created across, again, these 6 countries. So the program is essentially support for manufacturing companies as well as manufacturing enablers that are looking to expand. They can be greenfields as well, but greenfields which are probably have tried and tested sort of backup corporates. And the idea is to support these companies to do what they would maybe otherwise not do, to give them that support to unlock like key deals in these countries that can be transformational for the countries. Across manufacturing, they're sector agnostic. It can be in the agri business, it can be light or heavy industry, it can be EVs, basically anything that's manufacturing and that adds value. The implementation partners for this program are BDO, McKinsey. There's a couple of other sort of specialist partners like TechnoServe, Stewart Red Queen, and these tend to come when they're perhaps more agri deals. So I think the whole program is focused on trying to get Africa to transition from being sort of low productivity, simple manufacturing to more complex manufacturing, value addition, and higher productivity in Africa. So just before we go into the panel discussion, I just wanted to lay the scene a little bit and focus a bit more on what exactly are legal issues that would shape an investment deal. So looking at, first of all, the legal foundations, or what is the legal framework that should underpin any investment transaction. And essentially, this framework needs to protect both the investor as well as the target company or the company that's seeking this investment. And the framework should ensure compliance, transparency, enforceability as well. There's no point having a sale purchase agreement which a few years down the line when a real issue crops up is unenforceable because it's been drafted in such a language that it's not enforceable. So the idea is that documentation and legal issues should be taken care of early on in the deal so that we can build long-term partnerships between the investor and the company and long-term success of the company as well. So what is the key process? One of the key processes of this legal framework is doing a legal due diligence. And the due diligence is primarily from an investor perspective to identify any legal issues or red flags that would stop the deal from happening. And the key areas of focus tend to be governance. So governance, so how is, what are the Memmon Arts made up of? What do shareholder rights and board structures look like? Are there multiple layers? Is there a holdco structure? So, what does that whole governance process look like? Do they have a board? Are there independent directors on the board? Within the board, even on the exco, do we have the right kind of expertise, ranging from marketing to HR to commercial, to insurance and legal risks. So, within the ExCo, we make sure that those capabilities are met. Within the non-executive directors, ensure that the right expertise is brought in. So, the governance, what does the governance look like? Compliance, and compliance again can range from tax compliance to regulatory compliance. Certain financial sectors can have more compliance. For example, in the insurance sector, you'd have to comply with the regulatory authority compliance filings, your monthly, quarterly, annual filings. And then what are the obligations? So, what does the debt structure look like? Even within equity, what are the shareholder rights? Are they drag-along or tag-along rights in these covenants? Existing debt arrangements, what are the covenants? What are the repayment terms? What is the life? What does that look like? And I think very early on, investors like to know about these risks. So the outcome of a successful legal DD then builds credibility for the investment deal, between the company and the investor. And it's very important to build that credibility early on. So looking at key legal documents and looking at the non-disclosure agreement, there's a lot of legal jargon that generally puts people off. And if we look at a non-disclosure agreement, essentially, very few people look at that agreement once it's been signed. But it's a very important first step in establishing a relationship between yourself and the target, or between the company and the investor. And that's where the credibility starts building. When someone is willing to sign an NDA, that in itself is proof that they're willing to go that extra mile, they're willing to protect your information, they are in this process with you. So that's a very first agreement and legal document that builds credibility and some amount of relationship at the onset. And things like the term sheet and the sale purchase agreement, the term sheet can be binding or non-binding. I think on the slides we focus more on the non-binding one. But depending on which stage of the deal, it can be binding or non-binding. And often in the data room, a draft term sheet and a draft sale purchase agreement is already included, so that the potential investor, whether it's a DFI or a lender or an equity investor, can see the sort of terms that the company has in mind of how it wants to do this transaction. And then the data room, which is, again, a very important aspect of taking a deal to the next step. And a very clearly organized data room does a lot to give investors confidence in the process, confidence in the company. A company that's able to put all its documents really clearly on a data room straight away demonstrates that it has some kind of organizational capability, clarity, transparency, all of those things. So, and there's several other documents which I think later on we'll talk about, but the legal jargon for first-time finance raisers can sometimes be difficult to understand, but this is where maybe getting a legal counsel up front and having someone to support you and hold your hand from a legal point of view along the way is quite important. When a due diligence is done, I think it's important to have these red flags on quite early in the process. And the critical red flags that people look for is, informal business arrangements. So a company is carrying on doing business with key contractors and doesn't have anything in place, because then that contract can very easily be canceled, or from one day to the next, how do you guarantee that you will have certain revenues in place? Ongoing litigation, whether they're employee litigation, I think even that's an important part, because with several employee legal cases pending, I think it says something maybe about the management or management style. Or if there are lots of legal cases with suppliers or purchasers or buyers, and they are unresolved, then I think they point to a certain risk of operations as well. Complex governance structures. So what are the hidden liabilities? Of course, tax and things like that are often a liability, but there's also other liabilities that may arise from, complex shareholding structures, because that can, maybe hide some PEPs or hide people you shouldn't be doing business with. And then regulatory non-compliance, so lapses in tax filings. That, again, it points towards a lackadaisical attitude or an operator who's not very careful about these lapses, not investing sufficiently in your operational structure as well. And these things are important for investors because depending on the investor one engages with, they may be very hands-on, some may be more sort of strategic and as advisors to the board, and they want to be able to see that the company will sufficiently or successfully carry through the investment that they make. The key is, I think, preparation. So making sure you've taken best practices on board, really organize the data room correctly, engaging specialist advisors like legal counselors to make sure that the deal is sound and you prepared for it upfront, and then standardized documents. I've been through data rooms where version on version on version of the same document keeps coming on, and then you realize that, okay, so which one is the correct one? So, and it's possible that as a company transitions, there will be addendums to a certain contract or agreement that is an important one. But what's good is to have it clearly labeled and referenced, and then maybe even have a one-page or Word document that can explain the chronology of events that took place to get you from the start of the contract to the various addendums and why they were done. That kind of support, it could just be a very short one-page document, but that really adds a lot of credibility and value. Today's panel is comprised of myself, and we've got 3 really good expert panelists. So a bit about myself, and I on purpose avoided it right up front. So I'm Deepa Doshi, I work with BDO. East Africa is the partner for deals advisory. My background has very much been in finance, compliance, transaction advisory, corporate finance. And I wore a few different hats at leadership level, being from sort of country partner to at DCM BDO in my earlier, or my first life, and then doing M&A advisory with the corporate and investment banking team at Stanbic Bank in Kenya, and then moving into BDO to primarily take care or support the Manufacturing Africa program. And I've had a little bit of experience at cross-border advisory roles. So we have a very expert panel, and I see Rosa's already smiling from the side, but I've had a little bit of experience, but we have more experienced people on the panel today. So on that note, I will take a seat and invite the panelists one by one, and then they will introduce themselves, and then we'll move into the panel discussion. So firstly, John Maingi, investment manager at British International Investment. Really happy to have you on board today, John.
Happy to be here.
A brief intro of yourself
for
our audience here today.
Happy to be here. It's a pleasure seeing you all this afternoon. My name is John Maingi. I work with British International Investment. We are the development finance institution for the United Kingdom. That means that we are fully funded by the government of the United Kingdom. Our mandate is to invest in the private sector in emerging economies. What I focus on is on the energy access and efficiency team, which is decentralized renewable energy. So anything from CNI solar to mini grids to EVs, which we are all familiar with. Those are investment areas that I look at specifically. Pleasure to be here, and I look forward to the session.
Thank you, John. Thank you. Our next panelist, very experienced, Rosa Duarte Mutero, managing partner at Anjawala & Khanna, which is also part of ALN Africa in Kenya. Welcome, Rosa.
First, thank you to Luisa for making me wear a trouser. It's very wise. But good afternoon, everyone, and good afternoon, everyone online as well. Thank you, Deepa, for the kind introduction. My name is Rosa Duarte Mutero, managing partner at ALN Kenya. We're a leading law firm in Africa, providing legal services. I've been there for 24 years now. mainly handling mergers and acquisitions, so I feel right at home with the discussions today. I was laughing because Deepa was saying she has a little experience. Even the one she has with me is not a little, so that is good. Thank you for having me.
Thank you, Rosa, and a pleasure to have you with us. And our next panelist is Ashish Patel, Managing Partner at Avishkar Capital. Ashish is not new to many of you, and we've had him on our webinars and panels before as well. But over to you, Ashish, to do an intro of yourself. Thank you.
Thank you very much, Deepa. So my name's Ashish Patel. I think I look a lot younger in the picture. Kenya has brought my white hair now.
AI generated.
AI generated, right? So I'm the managing partner for the credit fund for Avishkar Capital. I'm based in Nairobi, and I look forward to our session today.
Thank you. Thank you, Ashish. So going on to the panel, first question to you, John. Why are legal aspects in a deal so important? And what are the key areas that investors like yourselves, like at BII, would be looking for upfront?
First of all, is to say you have to think about it from the stage at which you'll be looking at the legal aspects of a business. This is beyond the pitch deck. It's beyond the point where you're telling somebody about your business. It's now you opening the door to somebody seeing the innings of your business. And so you have to think about it from the legals inside the business show you whether the business really works. And the other thing is from how we view it as investors, and again, I speak not just for BII, but also other investors who would look at businesses, is, and I think Deepa mentioned it at the beginning, clarity and being upfront is extremely important, but the specific things that investors would look at, I mean, there's a number of them, but I think the main things is you're trying to determine who owns this company, who makes the decisions, and where do the risks sit. And what that means is naturally, the things that you'd look at is the ownership structure, things like licenses, key risks, governance, and the people in the business. By people, I mean also including how people are contracted into the business. What I've seen in the past is I have seen, and deals have come through me where the business is actually very strong business, very commercially sound, but they still lose out on the ability to get into a deal with investors because the licenses, the contracts, the shareholding is not clean. And this can look in many different ways, but I'll give a recent example of something experienced recently where we're looking at a telco company where they own and operate telco towers, and the license for the company actually sat in the individual name of the owner of the company rather than the operating company itself. That, of course, and the trouble is that this also came up much later in the process. And I think, as Deepa mentioned, the process between an investor and an investee is also a very trust-driven process. So if things are coming up very much later in the process, naturally, investors will tend to shy away.
Thank you. Thank you for that, John. As a follow-on, Ashish, you know, in order to get this level of information, sometimes legal due diligences can take time. So how do investors balance between the need to get all of this in place and doing a proper thorough legal due diligence, but alongside that, continuing the deal process and just continuing to make sure that you close the deal quickly? And anyway, in Africa, I think our markets deals take a little bit longer than, you know, some of the more developed countries. But having said that, how would you balance, you know, the time it takes to do both, and whilst you're doing the process of legal due diligence, not losing sight over what is exactly the deal for, and as investors, how would you do that here?
I mean, it's a good question and a difficult problem to solve, quite honestly, because, you know, I always say nothing in Africa is urgent. I think we move at our own pace, and I think there's a tendency in the market to always blame the investor that you've delayed the transaction for whatever reason. But what my experience has shown me is that, provided that you're working with great law firms like ALN, that beer, please. And a reduction in fee, yes. As long as you're working with good law firms, we've never found law firms to be the bottlenecks. And I'm just referring to the law firms because it's, we're addressed on the legal aspects. Where we've seen delays take place is really when businesses are not prepared with the data required for due diligence to take place. And there's a number of reasons for this, right? Because sometimes, if they've appointed financial advisors have not really quite coached businesses sufficiently to pre-warn them on what sort of information is required. There are very standard checklists that are easily available that businesses can be ready for before they engage in the process of raising capital or debt or whatever it is. But I'd just like to add one more question to John's point, where I think a lot of time gets spent is investing is not about legal agreements here. It's about bringing life to the legal agreements, right? Really understanding why they exist and what you as a sponsor needs to do to actually bring that about. Because you'll find plenty of businesses across Africa where they've got everything signed up, but they have no intention to follow through, and you get found out eventually. So that's one point that I would bring out. The second is that depending on the type of business that you're looking at, you should take a very focused approach on just diligence in areas that are risk areas for that business, right? So if you take agriculture as an example, there'll be agricultural risks that you need to look into. Titles of land or leases, whatever they may have, is a basic one to look at. Or where it's an export-driven business, do they have the appropriate licenses? But you don't need to look at every aspect of that business, and thereby doing two things: reducing the time, and just as important is the reduction of cost. And I bring cost about because we do Asia as well, and we've got quite a lot of experience in Europe. Our cost base in Kenya, as an example, in advisory fee is closer to UK than it is to India. It's about 3 times the cost to do a transaction in this country as it is in elsewhere. Now, all these costs have a role to play in reduction of the velocity of a transaction that happens, right? And we have to address that, and the only way we can address this is to start getting clever about these things. I think whatever you identify as key risk issues, no matter how time constrained a transaction is, you must satisfy yourself that you've solved or at least understand the risk that you're taking on. But do not be bullied into, forcing yourself through. But I think just as equally, sponsors should be able to be open enough to say why the issue exists and how they're solving for it.
So I think you've raised a really important point. And in order to maybe even get this balance, sometimes having an exclusivity agreement in place for those 2 or 3 months that it takes you to make sure that the risk has been taken care of while you're looking at the commercial aspects of the deal as well is an important aspect for investors. And so how early would you start negotiating the exclusivity for a deal? And the question can be to both of you.
And I'll just quickly jump in. For us, if there is an exclusivity, it will be part of the term sheet discussions, right? Pretty much up front in it. But we're also kind of now moving to a phase where, in addition to the exclusivity, we're seeking some further financial commitments as well, just to ensure that we are not being, either fished around or time wasting happening on our part. Because again, it goes back to what I'm saying, that time is the most valuable commodity that we have, and you've just got to understand, both parties need to understand the commitment that they're giving to each other on it.
Thank you for that, Ashish.
I'd say additionally, similar to what Ashish has mentioned, for us, we'd probably even look at it a bit earlier, at the point where you are signing an NDA and information is moving. That's probably the point where you would bring in the exclusivity, for the same reason that you've mentioned, that you'd need to do a lot of work beyond the point of the NDA to look at documents, to have Q&A and invested hours that will be in there.
That's important, yeah. So on that note, Rosa, how soon do you think companies should engage a legal advisor? Or is there ever a moment it's too early, or when would you say people need to start speaking to legal advisors?
Well, I'm probably the wrong person to answer that question because I sound like I have vested interest, right?
Yeah.
But the truth of the matter, it's far earlier than most founders think. And the short of it is, ideally, at formation, you should already really have your legal advice in. But if you're very late, between at most 12 to 24 months before you go capital raising. But to break down that answer, first I looked for a non-legal person to give me a fact so that I could answer that question. And the fact that I found is that investor readiness for advisors, I mean, when you have advisors in early, when you engage lawyers early, you move faster, you negotiate better terms, and you close deals way faster. Why? For those who are able to get their legal advice in at incorporation or at formation, what it means is they start with the right structure. They make sure they have the right shareholding structure, the right capital structure, and the right regulatory and legal framework to be able to do their business. That means by the time they're building the business and all the building blocks are in place. For those who don't manage to do that, because not everybody does that, but they do it, let's say, halfway through that, and they do it when they start commercially scaling their business. What are they able to do? They're able to make sure that as they enter into contracts, huge contracts that really matter, when they're going to things like intellectual property and protection of intellectual property rights, that means that when they're going into other countries, they have the right structures to scale. But if those two doors pass you and you now are really at capital raising, then making sure that at least you're 12 months before that, and not at the time when the term sheet appears on the door, makes sure that you're able to line up. The truth of the matter is the legal due diligence that we talked about is really somebody saying, I've been dating you and you've given me all these fancy stories about yourself. Can I come into your house and see?
Meet the parents.
Yeah? Yeah.
It's like
and
meet
see,
the parents.
You know whether you fold your clothes into the cabinet, do you put away, or do you wash the dishes in the... This is just exactly what they're just trying to do, right? So the earlier you start arranging things before they come into the house to check, the better, right? And that's why the answer is really as early as possible.
Thank you. Thanks, Rosa. And I think that's important. Because if the sooner you engage proper experts, then the sooner you know exactly what you need, and that whether you're on the right path or not. It's not just about having something for compliance sake, but actually what makes sense for you to have in place, even as you look to scale up.
It's actually less expensive because it's less expensive to build up rather than to go back and try and rectify things once things are in a structure in which you don't want them to be.
Yeah. Oh, good point. So John, just moving on to sort of ESG and compliance related issues and governance considerations. So increasingly we see that sustainability is an important part of deals, making sure that you've got ESG or UN SDGs being met. So how do you think those show up in legal due diligences for institutional investors? And what should companies do if they're not yet meeting those expectations? How do you think they should prep themselves or look to explaining that journey ahead?
All right, I'll break this into two parts. I'll speak to governance generally and how we look at it, and then the environmental and social part of things. You have to go back to the basics of where capital is moving currently in the world. A lot of capital now that is available for investment in businesses is really, really looking at the ESG part of things. How do you handle your business in terms of how do you handle the environmental issues? Do you have policies in place? How are you discarding of waste? How are you sourcing ethically? What are your policies around protection of customers? and employees as well, because we also look at that. And so you have to think about this from the point of view of the sustainability bit of your business is not just a greenwashing thing you do so that you can show investors that you are doing this.
Yeah.
Because at some point in time, if you can put all the things you want in the pitch and say that, oh yeah, we source our things from small farmers, we do all these things, but you will be caught up eventually. And I keep going back to this issue around trust and the trust relationship in investor versus investee. So you need to make sure that you build, as early as possible, you build that into the ethos and the operations of your business, so that you're not caught out at a point in time where you have to now start thinking about making fundamental changes to your business to get certain sources of capital. So I'd say you need to really think through how to embed that, because if you are looking to expand your business, a lot of pools of capital around the world are really looking at those things very seriously. It's not just a tick box exercise. And then I will speak to governance generally, because I think that's an important issue to think about. And what we always think of governance as, oh, I have a board, I have a CEO and management, but the way investors look at it is the governance, the stronger your governance structures, the easier it is to grow your business. And secondly, you have to think about it from the perspective of, if an investor is coming to look at my business, what does governance mean to them? Because governance is thrown around a lot. And I thought about it sort of in 3 different buckets. 1, they'll be looking for comfort that decisions are being thought through. 2, they'll be looking at comfort that risks are well managed within the business. And thirdly, that there's an ability to scale the business beyond the founder. And what governance structures give you is the ability to actually do all of those things. And you have to think about it from that perspective. A lot of times when we look at businesses, especially small businesses, it's normal for SMEs not to have the full suite of governance structures. But I think the differentiation becomes when there's a reluctance to build those governance structures in, that is where it becomes problematic. I think that's what I'd say to that.
Maybe I can just add
Yeah.
something to this, Deepa, and I kind of alluded to it, bringing legal contracts live, but this is a great example. See, people think about governance as, do I have a board, do I have physical people, but actually legal contracts are governance instruments in themselves. Therefore, we are beginning to spend more time to understand our sponsors, to see whether they are willing to abide by agreements that they've signed up to, right? If it's a loan agreement, are you paying on time? Because it's very usual here to kind of dismiss a payment on a regular basis and say, it's okay, I'll pay you next month. But those sorts of deficits are now beginning to get investors like ourselves a little more alert to saying, well, if something a person has signed up to cannot be followed, then how do we kind of get that trust gap, improve on the trust? So I think governance is just not physical, it's also about documentation.
Documentation, also how you're running your operations. I think it becomes very visible when you look at some of this documentation, if it's in place, and is it being actually implemented? So when you actually check, when are payments happening? Are they happening on time? That in itself starts proving stewardship and compliance, and the mindset of the owner starts coming through when you start looking at those kind of aspects. So I think we've focused quite a lot on the legal requirements, but looking at risks and going back to this, I think sometimes there are shareholders where there'll be a majority and a minority. So Rosa, the question to you, and in practice, which kind of legal issues have you seen most frequently crop up in SMEs in the African space during legal due diligences, and how do sort of interactions between minority shareholders and majority shareholders, how do those play out in practice, and what should founders be doing early on to avoid these kind of issues?
So, I mean, of course, different. There's no one size fits all, and everyone has different challenges based on how do I incorporate it, why, and the phases in which of development they are, the stages they are at. But I think one thing that we find quite common across is really around ownership, corporate structure, and ownership problems. And this manifests themselves in very many ways. And it comes from actually a very good place. 10 years ago, you incorporated a company, you incorporated it with a partner whom you thought you were doing the business together. Halfway through, they left and went somewhere else or started something else, and you just never bothered to change your shareholding structure. And at this point in time, you now have somebody who's actually a shareholder, but really should have no ownership rights. That's an example. Another thing is, of course, the same thing. You start off as good, equal, 50-50 shareholders, but somewhere along the line, someone has been putting in much more investment than the other, but nothing has changed in your cap table. And your cap table still actually shows, for most of our clients, 1 share each. As in, you don't even know how this business is this big. And its share capital is 2 shares issued of 50 shillings each to 2 shareholders. But it's just very frequent. And I'm not being judgmental. I appreciate that the focus was actually really in growing the business. Yeah? And wherever it is that we find the business, then we pick it up from there. But you find that, of course, at that point in time, we then have to go back and try and restructure the company to really evidence what the real ownership of the company is at this point in time. So that's one main problem that we find. The second problem, and I won't belabor it too much because we've already talked about it, is around governance and who makes the decisions, because that is really critical. When an investor is coming in, they really want to know who's the decision maker and who is the person responsible for this growth we want to come and invest in. That's what they want to know, right? The reason why anyone is putting money in your company is because they're impressed by what you've done so far. You've been able to build something good. But they really want to know who's the brains behind it. A lot of the times, it's quite surprising where the decisions actually come from. Yeah? And it's not whoever is on the register of directors as directors, right? And so we find that the governance structures, as represented in the legal documentation, is not what is actually being exercised in the company. And that's a problem because the investor wants the real deal. They want to understand what's the governance structure and how are decisions made. But more importantly, whether there will be any respect for governance structures. Yeah? That's what someone is looking for, to see whether there's been an institutionalization of how decisions are made. Because there is no way one day you're going to move from a kitchen table to a structure where you have formal board meetings and all overnight. And the investor needs to understand the journey that they need to take you in order to move you across the line as a founder. The last point, which we find in most entities all across Africa, is around regulatory compliance. Again, coming from a very good place. I just started my business small. I never knew it was going to grow this big. I didn't know what kind of regulatory approvals I needed. And I was just making the money and putting it in my personal bank account and moving on with my life. Yeah. And then now, oh, lo and behold, it's this big. What do I do about it? But what we find is, you'll find that maybe somebody did an acquisition at one point, they didn't get competition approval, which they are required to, or they didn't go and change their licensing to show that there's been a change of control in the business and what have you. So we find that as a huge problem also with businesses. And I think it's very important for everybody to ask themselves, because every business exists within a regulatory framework of one or another kind. And so it's very important to understand, who's my regulator? What do they require of me, and what do I need? Why do you need to do that? To avoid fines, to avoid legal tussles, and even problems with your financials, because financials don't want people with regulatory issues. They don't want that. They don't want people with Revenue Authority and tax issues because you haven't been paying your taxes. They don't want that because the regulator comes and finds whoever is there at that time, which will include the investor. So the investor is saying, please, whatever has been there before, please clean it up. So I think, Deepa, that's just very high level, the major things that we are finding when we look at businesses.
And maybe as a follow-on question, especially family-owned businesses, as they're transitioning from sort of the generation that started the business and moving to next generation, what kind of legal aspects or shareholder transition agreements should they be thinking about? I think, especially with family-owned businesses. I think even Ashish, you may have some experience of that. John, you may have seen. So just question to you, Rosa, first.
Very good question, because you'll find most businesses across Africa, even huge businesses, are really at the back of them family-owned businesses. That's just the truth of the matter. Even many of our companies that are listed on the stock exchange, behind them, there's really a founding family. And so that's why that question is really critical. Now, what, of course, we found is the issue of transition of governance for family-owned businesses is still an issue. Why? Because you find that there's a next generation of family members. They are running the businesses, but they don't have the instruments of power, so to speak. So they're actually not the directors. The directors or the shareholders are still the original owners, and transitioning that does take, is a bit painful across. And for many of them, actually, there are there's been deaths in the families, and there's been no transition of from one generation to the other. And now there's an estate matter that needs to be dealt with. And that's a point in time in which we want to try and bring in an investor. And estate matters don't get resolved quickly. And so that's another challenge that we find, that the ownership has remained with the first generation, hasn't moved. There have been transitions, including deaths in the family, and those also have not been transitioned. The other thing we see around family businesses is the ownership of assets. And you find that, of course, as would happen, founders donated their assets into the business to be used for growth of the business. But those assets are in the names of individuals, and they're not actually owned by the founders, I mean by the companies themselves. Worse still, and in many places across Africa, we don't even transfer from people whom we don't know. We bought, we paid, but just never transitioned the title deed. It's still an allotment letter from 1930s. And it causes a big problem, it causes some of the delays that Ashish were talking about, yeah? Because now there's nothing we can do until we can transition that ownership into the company so that the investment can be made, and then it takes long. So that's some of the challenges that we see.
And just to add to that, I think what we've experienced, or I've experienced, is that it's a fact of life that I can't remember the exact statistics, but it's less than, more than 80% of the family businesses break up after the third generation, right? But yet the governance structures have not been put in place. And that's just human life, right? Because children come, their dads have worked hard driving a little Toyota Corolla, and now the kids want to drive a nice little 4x4 Pajero or something. And that creates friction within families. Titles, roles are not clearly defined. So we always say, if you want to do a family transition into PE, it has to start a generation before. So that's literally a 20-year cycle that you have to think about. It cannot be done at the point you are trying to bring the private equity guy in, because there's going to be all these issues. And PE investors are not dumb, generally. They will pick up that a young CEO has no clue on how to run this business or to operate in. Many of these kids have come back from working in the US or studying in the US, where systems and processes are pretty well defined. And then you throw them in the middle of Nairobi or Kampala, they're not going to operate effectively. So you've got to take that into account.
Yeah.
I think the only thing I'd say that's additional here is from a practical experience that I've had before, where there was a particular business we were looking at the time. And yes, they do have the management that's in place, and they do have everything that you probably tick off. But later on, we came to realize that the decision making was actually ending up at the grandmother. So the matriarch of the family was actually the decision maker, who had not been in school. But if she didn't say yes to anything, then nothing would move. This is to say that I think, additionally to what has already been mentioned, it goes without saying that the cure to sort of fixing this transition and businesses dying with the third generation is to formalize as quickly as possible and then get independent people. When you have an independent director on the board or an independent management, one, it eases off the pressure from the family itself from making difficult decisions, puts decisions at the people who have the skills to make it and can look at things from an objective perspective without thinking about how they charged their land in 1999 to get money for the company. Yeah.
Thank you for that. Yeah. Ashish, maybe just as a follow-on, so what would you say is growing pains versus more serious legal issues and risks? And which of those would you say are fixable, or which of those would you say are deal breakers? And how does that influence the level of control an investor would want between sort of whether it's a minority or a majority investment in the deal? How do you see that playing out?
So to me, growing pains in general are not really legal issues that we find. The growing pains are, if I'm a tech business growing at 200% a year, how do I get my sales team to scale up? How do I get my finance team to scale up? It's about scaling and how do I get the operations of this business going? You may, in that process, find that because you don't have a great CEO or a FD or whatever, you haven't perhaps complied with some aspects of audit or something. It's important to understand what growing pains are being referred to, right? Because it's easy for somebody to hide behind the name of growing pains. Let's say, I forgot to pay my tax for 3 years. I'm growing so rapidly. You would question that. Or I haven't paid my NSSF contribution. You would question that. And I think when you start questioning, it kind of falls also where John was talking about the ENS audit. We tend to do what we call an intentionality review before we even spend any time, where we try to understand, has this person got the intention to do what's right for this business and for the environment and for social? Even if you're small, you can do the right things. You don't have to have money to do the right things. So I'd leave it at that, but you have to also understand that the cost, certain aspects, the cost of regulation is becoming so burdensome in many countries, including Kenya today, that many small companies will try and find ways to save money. Now, they're not trying to do that intentionally. Yes, they're trying to do it intentionally, but for a reason that they can't comply with certain aspects that they want to. Trying to export products to EU is an extremely expensive and difficult task, right? Because you've got to get HACCP, you've got to get certain certifications. All of that costs a lot of money. So I think you've got to give some leeway to understand, but you've also got to look at intentionality and what we actually mean by growing pains. Because operational, I get it. Legal, I don't normally. Yeah.
But I think I would add that, and for many founders in the room, nobody has a perfect business. And nobody's expecting that level of perfection. I mean, for the transactions we've done many years. And I think there's sometimes a lot of fear to allow somebody to come and see what you would consider your mess ups. And what you end up doing is then not scaling your business. I think then you're shortchanging yourself because you've made all this investment. And we do know at some point, unless you get a bigger engine, you really are, it's like refusing to move the gear. And if you're driving at gear 2 when you need to change it to gear 3, it actually begins to wear the business and to erode the value, so to speak. So I just want to agree with Ashish that the investor will be able to tell about your intentionality and that you're building a good thing and that there is potential in it. And so there shouldn't be so much fear to open yourself up and even learn, if nothing else, about what it is that you could have done right or what it is that you need to rectify to get your business to the next level.
Yeah. And on that note, Rosa, what do you think people need to look out for in terms of building into, say, a sale purchase agreement? How do they ensure that certain warranties, indemnities are in place, but are also enforceable a few years down the line? So what kind of clauses do you say should go into legal agreements and the transaction documents that need to be in place for a transaction to take place?
I think the thing to remember about agreements, because like we said at the beginning, the legal jargon can be quite daunting. I mean, we lawyers thrive from throwing around SPAs, NDAs, and things like that, you know, DLs and pull underwriting, what is all this that we are talking about. So the thing to remember, of course you need good legal advice, that's, you have to take that to the bank. But you need to remember that the legal documentation is about allocating risk. That's all we are trying to do. We want to say when things get bad, whose baby is it? Is it my baby, me investor, or is it your baby, you founder? That's all the legal documentation is about. So as a founder, the things you want to be clear about, one is your consideration. What's your valuation? And that should be well documented. Now, again, because people are people and human beings are human beings, supply is always here, the person supplying is always here, and the person demanding is always here, isn't it? So there's always the gap between what somebody wants to pay and what I want to be paid. Now, so that's an area to focus on and to understand what am I actually being paid and at what time. When am I being paid this? Of course, as an investor, they want to say, okay, I can see your business is good, but until the rubber hits the road, I don't know how much good this is, right? So I want to pay you maybe a little now and then see after 3 years whether there really is value. So of course, that's in the best interest of the investor. Of the founder, I want the money now, upfront, right? All of it. Plus what you will get in 10 years' time, and I tell you it will be very big, and don't worry, it will come, you know. So consideration is very important. Consideration, and that is how much am I being paid? When am I being paid? And is there clarity around it? Because there may always be clawbacks on what you consider is your consideration. And we found this a lot, for example, in real estate ventures. I know we're talking about manufacturing today, where owners of land have felt that they didn't get the real value that they thought they were going to get. But it's because they didn't understand what they were going to be paid, right? So consideration is very important. The other thing, of course, to know is what are the warranties that I am giving? It's very simple. The investor is saying, you have been running this business for a long time. You know where the dead bodies are buried, and you know what are in the closet. I don't. If they should ever come out, it is you we want to come and ask. That's all warranties and indemnities are about. But of course, after you've worked so hard, especially if you're selling most of your business, you want to go away to the Bahamas and enjoy, you know, Solomon Islands, wherever it is that you want to go, right? Now, you won't be able to do that, or you may think you're doing that, yet there's this big thing hanging over your head, which the investor is going to hit you with when the taxman comes and hits your business with a huge tax bill, yeah? So warranties and indemnities are about that. They're about what are the skeletons, and when things go bad, who is going to pay for that thing that has gone bad? So warranties and indemnities are also very critical. The other thing that's very critical is the conditions precedent. So what we say is, we've agreed to enter into an agreement to this joint venture for you to buy my business, whatever the arrangement we have. But to get to completion, there are some things that we need to do between now that we've agreed to enter into this arrangement and the time when we can say the deal has really been consummated. What are those things? Why are they important? So things like regulatory approvals, you can't get around. If you need competition approval, if you're a tech business or you're a fintech business and you need central bank approval, if you need insurance regulatory approval, all those regulators basically say, we want to know who's running these businesses, so please don't change ownership until you ask me. Your bankers who have invested in you and put money in you until now say to you, before you sell to somebody else and lo and behold, we are dealing with another shareholder, we want to know. So all those are what we call conditions precedent. Now, as a founder, you want to say, please don't make me do anything and everything. Like we've said, I was running a business, maybe I didn't do everything that I was supposed to do, but there are some things we can do now and other things we can do along the way. Decide which ones are important. And the investor will be able to tell you, for me, before these things are in place, I won't enter into the business. So that alignment between what is critical, what really must be done before we consume it is also very important. So your conditions precedent are also very important. The last thing I want to mention is, like with everything, you need to agree, when do we decide it's not working? Yeah? When we decide we are wasting our time, we tried and it didn't work. And that's very critical to include into your transaction documents, an exit mechanism. And the exit could be for many reasons. They could be because you agreed an investment horizon. It could be because things are not working like you assumed they would. There could be many reasons why you need to exit. But I always tell people, make rules during peacetime. So when we like each other, let's agree how we're going to leave each other, if we need to, and then use that as the basis to use it. So make sure that that is well documented in your agreements as well.
Thank you, Roseanne. That's a very sort of comprehensive answer to the question. So I'm being told time is up, but I want to ask one question, which will be to John and Ashish. Given time, loop it into one. But as BII, you're present in several jurisdictions. So just wanted to understand, how do you look at sort of cross-border investments? What kind of regulatory requirements and licensing requirements affect you? And Ashish, the follow-on question will be sort of, what kind of red flags have stopped you from investing in the past?
I think I'd summarize it as having cross-border operations. Cross-border structures are very manageable. However, confusion and inconsistency is not. So you have to think about it from the point of view of an investor coming to look into the business. Has to see some kind of consistency with the way the business works, consistency of the legal framework, even in different legal environments. And this comes down to things like, the things that affect cross-border transactions are things like tax, cash movement, shareholder protections, what is documented in the shareholding agreements across different entities. Investors usually look for clarity, like I said before, on where the value is created, even in these different countries that you're operating in. Where is the value actually created? What is the group structure? And what licenses are applying in which environments? And all these things need to be very, very clear to an investor who's coming to look into the business. Sometimes people compare international operations with complex operations, which shouldn't be the case. There shouldn't be a situation where just because you operate in Kenya, Uganda, and Tanzania, now you have a very complex web of businesses where one is supplying another, and you can't really tell where the value is being created or where the actual value extraction comes from. I think I gave an example before, but I think some of the things that I've seen recently that might tie into that point are around where the licenses are sitting in an operating entity in a different jurisdiction, and there's some kind of novation that is unclear. When investors are coming to look at it, the value of, if you're in a regulated business, most of the value in the business is actually in that license itself. And so if there's no clarity over where things should sit, or no way of really seeing where that license is, then this becomes an issue for an investor, and that's why an investor would look away from the business. So you have to think about it from, yes, you do have multi-jurisdictional operations, but you do need to think about how to simplify that in a way that makes it less complex for an investor to understand your business and your business model and where the value is being created.
Thank you. I think that's a very important point.
Yeah, so from a red flag perspective, and just to add to John, obviously there's the hitting you in the face things like shareholder disagreements or land disputes, family disputes, all that stuff. But what we are, as we mature as investors on the continent, is we are also doing full individual character due diligence using specialist firms, right? Because there are many things that a sponsor may not tell you, which he or she should have told you as part of your dating exercise, to take your analogy. We've intentionally slowed down transactions now, not because we don't want to do transactions, but we've adopted a method of doing transactions like in the West, where transactions are transactions. Normally the level of trust is high because of the way the systems work. Running processes in very short time manners here does not allow you to get to know the founders well enough or the management teams well enough, because the markets are just that much more opaque and information dissemination is not that great. So you have to take your time. If there is pressure on a transaction with processes or bankers, we tend to step out now, simply because we're not getting comfortable with the individuals. At the end of the day, we've realized you can have as many contracts as you want, but it's going to be up to the individual, because enforceability of contracts is a long, laborious process on the continent, which doesn't speak well for you, I know, but it's just a fact of life.
No, but it's actually true, Ashish, because when we are doing our legal due diligences now, and as a team and as a firm, we actually had to bring in, we now have a forensics business, and it's a fully fledged forensics business that's used for many other types of forensic work, but one of the work that they're doing is actually due diligence for acquisitions. And the issue is, you may have a balance sheet or a P&L, but you really do need some forensics work to be done to really dig into, do we actually have the stock we are saying we're having? Do we actually have the sales? Where are these assets that we say we are having? If they are spread across different borders, you can imagine, just trying to be able to be in a place where you actually really appreciate what you're buying, and the value and the assets and their existence has forced things like now we have to do some sort of forensics even before we do the legal due diligence.
Thank you.
I think just to quickly also add an annex point to that, it's also to emphasize that most deals don't fall through or fail to happen because problems do not exist around the red flags. They usually fall through or delay because problems are not disclosed in good time. I think, like we mentioned before, you need to make sure that at the point where an investor or whoever is coming to look at your business, you need to be as transparent as possible, as early as possible, to avoid a situation where now you're in this trust loop that delays an already quite complex and lengthy process. Yeah.
And that's a very important point as well, because eventually deals are people with people, right? It's always about the relationships first, the relationship between the investors and the company, and it eventually behind all institutions is people who are running it, and that level of trust and confidence needs to be built upfront and going on as well. So on that note, I'm going to move to the Q&A part of the session, and I think we have some questions online. So maybe let me start by taking one of the questions online, and then we can take a few from the room as well, and I've got several online. So the first question, Ashish, to you. You mentioned that transaction costs in Kenya are high. Can you be a bit more specific on the type of costs you're referring to? So that's one question. And then the second question is, very few manufacturing companies have the luxury of long-term contracts, but this is listed as a red flag. So how can one manage this?
From a cost perspective, the highest cost, very few transactions in Africa, outside South Africa, are intermediated by investment banks, which are typically the most expensive part of a transaction fee. But the fees we refer to are primarily legal fees, which form the bulk of a transaction cost today. E&S fees can be managed quite well. So most of my comments were related to around the legal fees, and then followed by the finance DD. I think the combination of those two typically are now ending up at around 7% of a transaction, which is compared to less than 2% in many of the geographies that we work in. On the second question on it's a very specific question, so it's difficult, not to have context to the type of business. So I don't think long-term contracts are necessary where you are, for example, doing an FMCG type of product where you're selling into the retail space and you're essentially selling product to thousands of consumers, right? So I don't necessarily think you need long-term contracts there, nor would you want a long-term contract with Carrefour there, as an example, because nobody gives you long-term contracts in that industry. But if you are for example, a business in a trucking business, a 3PL business, where you are putting up substantial amounts of infrastructure on the back of a promised contract, you would obviously want to see contracts coming out of whoever it is to say that these investments that you're making has an element of revenue that's attached to it going forward. So I think it's very business specific. I wouldn't say it's a deal killer. It depends on the circumstances.
I think that's an important point. I mean, I would say that you don't look at contracts in a vacuum. You kind of look at those contracts to back up the model that has been shared. So, the revenue streams that are being projected, are they justified? So you're looking at a contract from that perspective. And so it could be a one-year contract, but if you can demonstrate that historically you've had this customer for the last 3 years and every year they've been renewing, that gives confidence, right? So it's very much about the context in which you're looking at the contracts. Maybe a question to Rosa, and this is going back. So how can the first generation navigate competency doubt on the ability of the next generation? So competency doubt on the next generation.
I think that's an age-old problem.
How can the grandmother move to sort of trusting the grandchild with?
I don't think that will ever happen. I mean, sometimes I listen to myself with my children. I'm like, my mom used to say this to me all the time, right? Because there's always things like, you never listen, I'm like, how come now I think somebody else is not listening, right? So in terms of competence, actually, I think for older generations, we need to be, it needs to be very clear that the younger generation can only be as good as you have trained them. It's just the truth. And it's actually an indictment on the older generation. And I think, like Ashish said, you have to start generations before if you're trying to have good succession down the line. And so I think that, first of all, it's never too late to train. It's never too late to build their capacity. It is important for the older generations to make sure that the younger generations are able to go out into the world, get the training that they need and the exposure that they need before they can come back and be good for the business. And I think that that period of sort of letting go to bring back is also a way that has been successful for many. It doesn't mean everybody who doesn't go out then is not competent, but I'm saying that's been one way of making sure that there is faster growth, because of course our children would grow better when they're not with us and they're not being mollycoddled, as it were. And so my starting point is it needs to be something that the next generation is interested in doing. Yeah, because that's probably part of the biggest problem, that people find themselves doing these jobs because their parents are forcing it down on them. They are feeling this pressure of, I'm the firstborn child, who else is going to do this? And the disappointment in my father or in my mother's eyes is just going to be too big. So first is just to start with, is there interest in it? And then if there is interest in it, how are you training and allowing for the training to happen, whether with you or away from you? And then building the trust in terms of letting go. The truth of the matter is, if the world is changing as fast as it is, it means your children are actually more competent to deal with today's world than you are. That's just the reality of the matter. Before people talk about AI, technology, and things like that, things are past you like by kilometers, right? Not so for your children. So they would be better off actually understanding how it is to grow your business in today's world. And so trusting them and allowing them to do it. And I think older generations forget that they also had mistakes into being allowed to make those mistakes that got them where they are. And so allowing also that generation to falter as they would, find their feet and move on, I think is also critical.
Maybe I can also add to that one from a recent experience that I've seen, and this is just also observation of most family businesses. You would find that probably the older generation were the starters of the business. So for example, the old man was, at the beginning of the business, was the accountant, the sales, the procurement, the everything, right? And and has probably continued being shadow accountant, shadow this, that, and the other, even with the structures. And so I think there's a point to be made around the measurement of competency, because the generation that starts a business are used to running things in a very informal kind of way, and would then, the expectation of your son who has gone to Oxford and has lived in the UK for the last 15 years to also follow the same might not necessarily be fair. However, with the formalization and putting structures in place, then the competence threshold actually goes a lot lower, if you want to call it that.
So I don't know if we want to take any questions in the room. There is one there. Go ahead. I have a few more online questions, but we can take one or two from the room first.
Yeah, mine is...
Just introduce yourself.
my name is Rogers Odima, the economic advisor of the governor of Kiambu. So I come from the government a bit. So 2 questions I want to ask. One is, these investors we are talking about, do they also do franchising, or they are just people who want to get quick profit? Actually, it has been said that a lot of these guys come and after maybe even when they buy that business can sell the assets and walk off. So are they just guys who want quick business? Secondly, the issue of, I know we talked about, and even Rose has just talked about that issue of competence and coaching. Do these investors also put in a bit of, do they walk along, or is just those legal documents you are talking about? You know, once you sign the legal document, that's all they care about. Sorry, I know I may not understand the whole this aspect, but those are the 2 things that are coming readily. Number 1, what type of investors are they? And number 2, do they, for example, have patient capital? Is just capital they want to put in, buy you off, or even just put in? And like you are saying, all they just care about is the profit, the cash flows, how you arrived there. And, by the time I think you arrive at some of those cash flows, there has been so much sweat, so much tears. Thanks.
Thanks. Thank you. And I think Ashish, you can take that first. Maybe John follow. Yeah. It's a very investor-driven.
So I think on the investor side, I would say in general the investors I know of in Africa are not the invest and walk away. I mean, firstly, in Africa, nothing's quick, right? So exit's the biggest issue. So I don't generally see that as a problem. Perhaps there are small family or private transactions that may be, flipping expensive money during a distressed case. But by far, I would say these are investors that have come with sophisticated capital and are looking for long-term capital growth, right? So typical investment hold is 5 to 7 years. Within that period, I think there are different types of investors. To your second part, some investors are passive investors, and they'll call themselves as passive investors because they'll say, hey, I'm putting money behind you. You are the expert. I expect you to grow this business, but I'm giving you the turbocharge to do it, the fuel to do it. And some investors will say, I'm coming with operational skill sets to help build your business. So I think to a great extent, it depends on the founder to understand where are his shortfalls and where would he require help. I think in the early venture space, I mean, again, you differentiate between venture and PE. And if you listen to some of the best performing private equity funds or VC funds, particularly in the VC industry in the West, they will say that if I have to do a lot of operational skill sets to a person I'm backing, I've backed the wrong person because that's why you're putting money behind him. But nobody's perfect. As Rosa said, I think everybody needs some element of help. So perhaps your business requires a little bit of support on the finance, or how do you set up the finance department, or how do you... Sure, those are areas that investors can work with you, or at least help you with their network to bring the right competency.
Yeah, I think the only thing that I would add here is, one, the term investor is a very broad word, very large spectrum, and there is everything from things that look Sherlock-like, like a Sherlock, and things that look more strategic investor. I'm here with you, for the long term, right? And so I would also turn it around and say that I think one of the most important things that you need to think about when you're financing your business is, who are these people? What are they? What are these people, and what are they here to do? Before you even get into the "I want 5 million shillings" conversation, I think it's very, very important to take that time to understand. And I think Manufacturing Africa has done a very good job with this series in terms of making sure that this information is available and that people are able to understand, and this world is demystified. I think what I'd say is that, just to echo what Ashisha said, because I also sat on the private equity world, generally most investors in Africa are not here for overnight profits, because it's not a possibility. Most investors are here for sort of medium to long term, some longer term, some shorter term, including on the debt side of things. There's commercial banks that do debt. You'll get a 3-5 year loan, and then there's us who are sort of going to give a longer tenor loan with more concessional terms, because we are more interested in the developmental part of things rather than the profit part of things. So what I'm trying to say is that the spectrum of investors has different interests, and you have to think about it from what is the interest of the investor who's coming to you.
I think to say you have a choice. You have a choice to decide which investor you want. And just the way they are taking so long to choose you, you also have to take very long, because this is a partnership, yeah? It's a partnership. And if it's going to work, there's got to be a fit. So you, as a business, must ask yourself, what am I looking for? You could be looking for someone to help you with governance, actually. It's structure. I need strategic advice. Is there somebody who can bring strategic advice? They'll bring the capital, but what I really want from them is to help me with the strategic advice. Yeah? For example, you could be getting this investor because they have a distribution network which you want to tap into. So they are bringing money, but they're also bringing the distribution network. So that's what you need from them. So I think identifying the need that you yourself have, even before you start the relationship, is very critical. Be clear, this is what I want from these guys, and if this is how I want it from them, and that's when you take it. But if it's not going to fit into that bill for you, then don't even start.
Yeah, now that I represent, or rather I'm supposed to represent SMEs in Kiambu, is there a supermarket where, like you're saying, those range of investors, how, if I was to advise my SMEs in Kiambu, I want to go to that supermarket, so where is it, where can I find it?
So yeah, maybe I can take that first, and then, so essentially not really a supermarket, but I think to what the panel alluded to, there's a broad spectrum, and you can start from commercial debt to sort of concessional debt, DFIs who give you more of a long-term view, and then looking at private equity investors, and then strategic investors. So that's in a nutshell, that's your spectrum. But it's like, the day you decide you're going to date someone, you need a profile in mind. What kind of investor will suit you? And it's good to put that down on paper, to actually say, what kind of investor do I want? Do I want someone very patient? Do I want someone who's more impact driven? And to an extent, that's also determined by the product that the company is promoting. If the product is more impact driven, then it's more about getting impact investors who are not so worried about the bottom line or the return on capital. For them, return looks different. For them, return is about how many women did they reach out to? How many small-scale farmers have they supported? What is the income generation they've got in that area? So it's about those kind of targets. And then, obviously, commercial banks will, for them, it's about lending, and it's very contractual, covenant-driven. Payment terms are quite fixed. Interest rates are fairly fixed, or rising as per the economy is transitioning. So it's really about building that profile in your mind and saying, where do you lie and what will suit the business.
Dating site.
Exactly. That you put in your...
Yeah, so to add to what Deepa said, because that's absolutely true, you do need, we have what we call transaction advisors, and you're asking for an SME, who is that? Because they wouldn't know to come to BDO or maybe to Stanbic. But many times just your relationship manager in your bank, because that's a person an SME can have access to. Your relationship manager can actually help you to understand what you're looking for. And if they are really good, they won't just tell you take a loan. They do have access to various other capital raising options. And unless a person running a small business should be able to tell the banker, what else can I do? And these days we see a lot of impact investors partnering even with banks, yeah, to provide the kind of financing that an SME wants. That may not just be, it could be a bank, it could be a debt, it could be quasi-debt, it could be nearer capital. And so that's what you need. You need a financial, what we call a transaction advisor. A sophisticated name for them is an investment banker. Yeah? But for an SME, really, even your relationship manager should be able to explain some of these things in a broken down way. I don't know, Ashish, what you'd say.
No, I would agree with you, and I'd encourage you to do a few things. We identified this issue. The problem is what we refer to internally as discoverability, right? Because your SMEs are not being discovered, and there are many reasons for it. And I always give the equation like here in Kenya, we don't have a database. We have a big team of people scouting for SMEs, right? There's no database to say, I want an avocado producer in Kiambu. In UK, I can do it and it'll give me by the geography of 50. So first, almost a plea to you would be establish a database that's available to the public, which is showing off your SMEs in the district. Second is we've, for 13 years, done what we call Sankalp in Kenya. It's held this year at Sarit Center. It's about 1,000 entrepreneurs that turn up, where the entire ecosystem of lawyers to entrepreneurs to foundations to equity guys turn up, and that's where you do your fast dating. Yeah. So you can meet the entire crowd and get your SMEs to get educated around the ecosystem, because we're not good in Kenya, in Africa, around ecosystem linkages yet.
On that note, maybe a question to Rosa. When you identify high risks post a legal DD, how do you determine that these risks are high enough to advise the investor not to proceed? So, what kind of negotiations do you go through first and then eventually say, okay, this is too high risk, we shouldn't proceed?
Remember we talked about that when you're doing a transaction, the main issue is just risk allocation. All we are asking is, if anything goes bad here, who is taking the loss? Who's going to take the loss? And you get a red flag where the loss is so big that nobody wants to take it. Nobody wants to backstop it. And it takes various forms. It could be that, let's say there's a litigation matter that is ongoing. You could have a situation where, let's say, there's a class action against this enterprise because they did one thing or the other. And the investor is saying, if this litigation goes bad, you need to pay for it. And the founder is saying, I don't want to take that. I don't want to that my money, my personal money is what is on the line. If the litigation goes bad, the company can become bankrupt. But what the investor is saying is that no, the company will be okay. It is you who will put your money on the line. You get the difference? And so at that point in time, we would be saying that the red flag is too high. Anything that is existential, so for example, issues to do with tax, issues to do with regulator approvals and consents, issues to do with fines and things like that are always red flag issues. And usually what we would do is we have a traffic light matrix that we explain to the clients when we are doing the diligence, where we mark an issue either as red, high risk, orange risk, or green risk. Green means something that you just need to know it's there. Once you finish the transaction, you will clean it up. Orange means that it's serious enough, but shouldn't stop the transaction. Red means unless it is sorted, you cannot be able to solve it. An example of red is if there's a third-party shareholder who is not on the table. who's actually had shares, but they're no longer in the company anymore. You wouldn't want to invest in a company where somebody could come and say, I actually own 50% of this business. So what do? You ask the person to solve the issue. Look for the person, buy their shares, remove them from the shareholding. That's the only way I can buy that business. So that would be a red flag risk. So the only issue is, once we identify the risk, what makes it high risk is when nobody is willing to take that risk on, either to solve it or to carry it through into the transaction.
I think you, if I could just add here quickly, I think you raised a very good point around carrying of risk. And I think the way that it works in practicality is the investor will look at whether they are willing to absorb the risk or whether they are willing to negotiate that risk into the contracts. So some of those things, depending on whether, of course, a red might not make it there, but oranges and greens might make it to the point where it's a condition precedent in the actual documentation, where you're sort of giving you're giving the investee time to fix whatever issue it is because it's not so massive.
Thank you. I think we're out of time. I have a couple more questions that came from the online attendance, but we'll try and answer those questions separately. What would be your one parting comment or one-liner about legal issues that people should look out for in a deal? Maybe Ashish can start. And then
I didn't think about that one.
Ooh, okay, then
One-liner and legal.
One-liner, legal. Trick question.
I go back to me, it's not about legal. I think legal is simply documented. To me, it's about trust and trying to understand the sponsor and whether disclosures are happening.
Rosa?
I think it's one that I said, make rules during peacetime. Agree how we are going to deal with issues. That's all we are agreeing in the legal documentation. That's why we do the diligence. That's why we do the transaction documents. It's just to say we are planning to do something together. If things go like this, we will do this. If things go like this, we will do like this. So just make rules during peacetime. I think that's really important.
Mine would be very simple, and I think I've mentioned this word quite a number of times, but no investor expects perfection, but investors do expect transparency, preparation, and willingness to professionalize as you grow. Simple as that.
I agree with that, and I think for me, the one aspect about legal documents and everything is look at your business first. Make sure that the contracts or supporting documents or growing alongside the business don't just get so commercial and so driven by trying to grow that business that you forget about the housekeeping and making sure everything's in order and making sure you've got proper contracts in place, whether it's with your buyers or suppliers, and making sure it's all well documented as far as possible. Yes, of course, businesses are moving very quickly, but it's about having your house in order, because if your house is in order, then to that extent, there'll be fewer legal issues that come up in the deal. And on that note, let me invite Chandni back to the floor. And I hope this discussion was fruitful for everyone, and we all took home some points.